read this white paper. It was a Celestia white paper in 2020, so about 5 years ago, and the idea behind it was so brilliant and so elegant and powerful. To me, it was the most exciting paper and idea that I encountered in crypto since reading the original Bitcoin and Ethereum white papers.
Hey everyone, welcome to the Level Up Podcast, presented by the Medici Network, the exclusive community for financial institutions to engage with blockchain-native funds and founders. I'm your host, David Breiter.
And I'm your host, Sean Farrell. Before we kick things off, make sure to hit the subscribe button and follow us on Twitter for the latest episodes.
This podcast is for informational purposes only, and nothing herein should be considered financial, legal, tax, or investment advice. The views expressed by our hosts and guests are their own and do not reflect those of the Medici Network, Fundstrat Global Advisors LLC, Finality CP Management LLC, or their respective affiliates. All listeners should consult their own professional advisors as to the legal, tax, financial, or other matters before making any investment decision.
Now, let's get into it.
Hey everyone, welcome back to Level Up. David and I have a fun conversation on deck today. We're going to be talking about Celestia. We're going to be talking about Celestia with Nick White, COO of Celestia. David, before we get into it, how about you walk us through some of the high-level stats on the token?
Yeah, that's right, Sean. So Celestia, ticker is TIA, T-I-A, trades at about $1, and the market cap's around $800 million dollars today, and it's a data availability network. And I know that might sound a little maybe in the weeds for some people who aren't maybe blockchain junkies, and we'll talk a little bit about what that does. But basically, infrastructure for scaling blockchains in a certain way. And some of the competitors for that are Ethereum itself. Data can be posted there, but also other specialized players like EigenDA, Veil, NearDA, and others. And Sean, maybe tell people a little bit about the difference between their approach and some others.
Yeah, so right now in the blockchain world, there are two broad categories of scaling. You have monolithic, which you have, the core functions of blockchain, which you could break them down to execution, settlement, and data availability. They all happen on one same aggregated layer. You could think of Solana as the best example of a blockchain taking this approach. But, in Ethereum world and elsewhere, you have a more modular approach to scaling. And so, Celestia is trying to offer a solution in which blockchains can take care of execution and settlement and outsource that data availability layer to the Celestia blockchain. I've heard a crude analog to Web 2, be posited as Celestia is kind of AWS for blockchains, which, I'll bounce off of Nick. He might have, some feedback on that, but I think that's a good framework to start with.
Yeah, it certainly is infrastructure, and it's infrastructure for this trend of pushing things to off-chain and settling on-chain. And, obviously it started and really gained steam with Ethereum, the quote-unquote layer twos, the ones people maybe are most familiar with, maybe something like Base from Coinbase. There's been a lot of transaction activity there. And, both in the number of layer twos and the activity. And, those fees they have to pay to put the data that happens off chain onto the main chain or somewhere where you feel secure that data that happened is correct. And what these networks will do is they'll settle to a different chain that'll provide consensus or data availability over the transactions. And the historical way it was done was posting to Ethereum on the main chain and call data. And then Ethereum launched blobs. And, that was a cheaper way to do it. And you can see here on this slide is the fees per megabyte of data posted. And we have Celestia and Ethereum on the left-hand side. This is the longer-term chart. And you can see Ethereum used to be very expensive. And it's gotten much cheaper recently. And that's because of that one of these upgrades. And we'll talk about that in a bit more. And this is zoomed in on the right is the more recent chart. I think it's over the last year. And you can see Ethereum is now actually cheaper than Celestia, which maybe is a headwind for them. But the other side of that is that you also see spikes in the Ethereum fees sometimes. And, that happens when blocks get full. And, one thing, Sean, we talked about on our interview with Vitalik was that, he would be in favor of actually raising blob fees. So maybe that would be a catalyst for Celestia. But let's, what else are you seeing for the market share?
Yeah, perhaps that cost advantage for ETH does go down, and that is a good point regarding volatility. If you look at provider market share, you can see that ETH still has the plurality of the data availability market. I think that has a lot to do with the main users of data availability solutions right now are L2s, and the proximity to ETH kind of makes sense for those chains to use. In second place, you have EigenDA, which is another competitor on the market, and then Celestia in third place.
That's right, and that was data share, and this is the fees that are charged for that. We mentioned Ethereum fees were very expensive before. You can see they used to make up the majority of fee revenue, and it was actually quite meaningful for the Ethereum blockchain. I think this was monthly. At some points, they were making about maybe 4 million or more a month at the height, start of 22 or 25, or at the end of 24. And it's declined drastically since that upgrade. And on the right-hand side, you can see since May of this year. All of it has really declined across the board. Interestingly, EigenDA, the new player, in the last complete month of October, was actually had the most fees, but across at 4,000 a month, but across the board, still very low overall for these players currently. And it'll be interesting to see if pricing pressure, competitiveness, if there's ability to raise prices and generate more fees. Sean, there's different types of fees in Celestia. What kind of revenue can they earn?
Yeah, that's right. So Celestia is a blockchain, right? And so there are your typical transfer and staking, unstaking fees that the node operators will earn. But of course, there's also, and as signified by the purple bars here, you have fees paid to post data, and I think that is the more material data to look at here. And you can see that at the outset, when the chain first launched, the vast majority of fees were from those non-blob typical blockchain fees, and over time those fees have waned. And over the past year, the majority of fees have come from data posting. Although, as you can tell, those fees have also drawn down quite precipitously since about that April timeframe.
Yeah, and let's just dive a little deeper. Obviously the top line number is important for data fees, but thinking about the customers and the customer makeup and that trend, it looks like one of their main customers for a good portion of the data fees and the data posted and the fees from that is a network called Eclipse. For those who don't know, I think Eclipse it's a Solana SVM, meaning the Solana virtual machine implementation that is a layer 2 on Ethereum, effectively taking a version of Solana and attaching it to ETH and making it an L2, and then putting some of the data availability, again, mentioning back to the first slide of breaking things up, putting some of the data availability onto Celestia. So that's Eclipse, but I think again, it's about 50% share here. One question is, the chain itself hasn't had strong performance as of late, and it's, I guess you have to wonder if one of the top customers is kind of having weak performance. I'd be very interested to hear from Nick, what he thinks about the future outlook for getting new customers, and I'm sure they have a number of things. Here's a picture of the roadmap, and it'd be interesting to hear what he thinks will kind of drive new customers and usage.
Yeah, that's right. And then obviously, I think we just covered the demand side of the equation pretty in depth. But of course, on the supply side, you have another host of issues or things to be concerned about. I actually think that this is one of the interesting tailwinds for the protocol here. And I'm excited to get Nick's thoughts on this. So one of the reasons, beyond just a broad lack of adoption of the overall category, Celestia has been hamstrung by its supply schedule. They front loaded a lot of the unlocks and new issuance, in the first couple of years of its existence as a liquid token. But, as you can see by this screenshot from Tokenomics, most of those major unlocks are now, behind us. And, that could be, I think that's an intriguing part of Tia's story here.
Yeah, I agree. I think, there was, some news of there being a headwind from some of the staking early VCs. I think, Polychain, it's pretty notably and publicly known that they were kind of staking and selling. And, but I think I did hear, I think that they transferred that block. So they got it sold in the secondary to another investor, hopefully. Maybe that relieves some of the selling pressure. And, I think, as the inflation winds down, it does look like, this might be a more compelling part. Next cycle, I think they're going to go from, the meta of low float, high FTV to high float token. And if the fundamentals can, return, it could be in a category that's, at a certain price or the right price with the right fundamentals, could be in a category that could be investable next cycle. And, here's a picture of just the market cap and the price since November of 24 here, obviously trending down together, but the supply is obviously increased here. And then here we have some of the comps. Sean, tell us about the comps.
Yeah, so the comp set right now, in terms of data availability solution, this isn't a perfect chart. But you can see, I think the direct comps here are, Eigen, which I guess, they also have solutions like restaking, solutions beyond just data availability. But, the whole landscape, you have ETH, obviously, near Eigen, protocol called Walrus, Avail. And, really outside of ETH, none of these tokens have done incredibly well over the observed time period, really just asymptotically moving towards zero. But I think that's just the nature of the current market, current landscape. But it's tough to draw too many conclusions from this here.
Yeah, I think that's right. I mean, it's been a tough year for tokens overall. And, I think on this chart, this is the fundamental comps for the DA set. The pure plays really, I mean, if we're talking about the pure plays are Celestia and Avail and maybe Walrus, I think. But Ethereum obviously has a multi-purpose blockchain, and Near obviously has its own blockchain, but a DA solution, and Eigen being a restaking plus a DA solution. You can see some of the fundamentals in terms of the revenue and fees. On the pure plays, you don't really have much generated in terms of revenue for these. It's obviously a newer category that's finding product market fit and monetization. And you can see some of the multiples are unknown or quite high for many of these outside of the, I guess the two blockchains, which are, kind of more blockchain, general purpose blockchains as well, like Near, with some AI focus as well, and Ethereum, of course, being the cheapest. And, like any growth investment, I think it's hard to, you have to take a VC lens. It's hard to kind of analyze these, truly with just revenue and fundamentals. You have to really understand what the outlook is like, and I'm sure Nick will tell us about that.
Yeah, that's a good point. This really is a good example of liquid venture, right? Because, and we'll get Nick's thoughts on this, but you do have to assume, obviously, that Tia wins or obtains a good market share within this category of data availability. But there are some assumptions that have to be made about this category expanding, right? And the overall crypto ecosystem and the need for data availability expanding over the next 10 years.
Yeah, that's right. Really, at the end of the day, you're betting on more things coming on chain. That data is going to create a lot of data. Data has to go somewhere, and you need secure networks to form consensus on that and make sure that these blockchains function properly. So this is a chart of Tia's technical trend. We like to keep it simple here on Level Up. I just think we can just generally say it's been in quite a downtrend since it topped in about the end of 2024, and it's been in this down channel. But maybe one thing that could be encouraging for it is that we like to sometimes look at these DeMark trend reversal indicators, and this is on the weekly chart. And we like longer time frames generally because those give you kind of hopefully better signal. But we did get you got a 9 buy and a 13 buy, which sometimes they do and don't work. But generally those would be looked at with some degree of positive that there could be a turnaround possibly near. But some of them haven't worked in the past as well. And I think also, I mean, the thing really is, can the fundamentals, when we talk to Nick, for me, can the fundamentals and the story and the opportunity kind of match up with what this chart might be saying the opportunity could be? And that's what I'm excited to hear about, Sean. How about you?
Absolutely. Yeah. It's look, I don't know if they're going to get to a million revenue per day in the near term, but in markets, it's, especially in liquid venture, it's all about rate of change. And so if you can provide some guidance into customer acquisition and perhaps forward-looking growth, I think it'll be very interesting to hear and could further reinforce a potential growth story.
I think that's right, Sean. And with that, let's get into the show.
Let's do it.
Welcome back, everyone. Excited to be talking with Nick White, COO and founding team member of Celestia. Nick, welcome. How are you?
I'm good. Thanks for having me on. I've been a big fan of the show. You guys are really, I think, stepping up the game for, having a more investor sophisticated sort of like conversation about crypto protocols and assets.
Well, we're trying. Appreciate the sentiments. So why don't we just jump right into it? Celestia has been central to the modular narrative. I think that narrative has kind of ebbed and flowed, but has, behind the scenes been building pretty steadily nonetheless. So maybe before we get into that, can you share a bit about your background and what drew you to this project specifically?
Sure. So I'm an electrical engineer, computer scientist by training, have a bachelor and master's from Stanford. Actually, my focus was in AI. Before I fell down the crypto rabbit hole in 2017 and 2018, I co-founded a project called Harmony, which was a layer one blockchain focused on scaling. So like the theme of my 7 years in crypto so far has been trying to solve the fundamental problem of like the bottleneck of scaling and like building performant infrastructure for blockchains. And so I worked at Harmony for a few years and eventually read this white paper. It was a Celestia white paper in 2020, so about 5 years ago. And the idea behind it was so brilliant and so elegant and powerful to me, it was the most exciting paper and idea that I encountered in crypto since reading the original Bitcoin and Ethereum white papers. So pretty quickly after that, I was like, I want to be involved. I almost couldn't sleep for 2 weeks because I was so excited by it. And then, got in touch with Mustafa, who wrote the paper, and the other co-founders, and eventually joined the team full time. And so I've been, full time on this project for the past 4.5 years.
And on that note, maybe you could tell us a bit about what enamored you with that white paper. Walk us through the modular thesis and, how Celestia is building around that thesis.
Modular is a word that kind of anchors and explains sort of the broader architectural innovation of Celestia. And that is that, we're splitting legacy blockchains coupled execution, which is like smart contracts and all the application logic, with the underlying consensus algorithm and like the block space and building the actual blockchain. And what's innovative about Celestia is that we realize you can actually decouple these things. And when you do that, you get a ton of advantages. First of all, you enable developers to actually touch more of the stack and customize things more to the needs of their application. So you're not stuck in a one size fits all, general purpose blockchain. And then on top of that, you get much better scaling properties at the L1 such that you can increase the overall throughput of the network much more quickly and with fewer trade-offs when it comes to decentralization. So that's the core innovation, and modularity is like this idea of splitting those things. Now, I think that the relevance of Celestia is goes much beyond that, right? Because this is an idea that has ramifications for all of crypto. I think that long term, the infrastructure like having the right infrastructure foundation to build on is one of the things that we need to absolutely get right. And frankly, I just, even as a L1 founder previously, felt that nothing was really living up to the challenge. And I look around today at the existing ecosystem, I still don't feel like outside of Celestia, things are really tracking towards the right architecture for the end game. And so, Celestia is kind of pretty much on its own as far as like still like pursuing this thesis and pursuing this long-term architecture that I think is right for applications and for, the industry more broadly.
And so just unpacking that architecture a bit further. So you have execution, right? Settlement, and then in between that, or however you diagram it out, there's data availability. That's where Celestia sits. And I think it might have been you, or it might have been somebody else kind of framed it as AWS for blockchains. Is that the right way to think about it?
I think that's a really good mental model. And, I do think that there's been a lot of chains, the risk is that you might start to think that it's actually like a decentralized storage or decentralized AWS in the sense of like, there's a bunch of DPIN networks that are like trying to resell, decentralized storage or decentralized like compute networks to run like normal cloud workloads. But Celestia is a cloud sort of model for actual deployment of blockchains and blockchain networks. So Celestia is like a sort of a network of networks, if you will. And the right way to think about this is that one of the core innovations is this idea of a rollup or a layer 2. And I don't like those names because they come preloaded with a lot of connotations from coming from the Ethereum ecosystem, that rollups and L2s are these like sort of baby chains to a mothership like Ethereum. But really, what a rollup is a virtual blockchain. And the same way that like cloud computing was enabled by this idea of a virtual server, where I, as a developer, can go to AWS. They have built out all the physical infrastructure and compute hardware, and I can tap into that on demand as if it's my own, physical server that I would have built in my office. So it's a similar architecture in that Celestia has all this raw block space. It's a very scalable network with just the raw ingredient for decentralized compute. And as a developer, I can deploy a virtual blockchain on top of it on demand. And so it totally flips the economic model of launching your own chain. It gives developers significantly more power and control over their application stack than you would have on a standard L1 like Solana or Ethereum L1. And so there's just a lot of the same reasons why the cloud computing paradigm has absolutely dominated Web 2. I think for the same reason, this sort of like modular, sort of roll-up centric, virtual blockchain centric developer paradigm is going to dominate in Web 3.
Nick, can you walk us through maybe like a transaction, maybe in the paradigm before Celestia or without, if Celestia didn't exist today, and then the end-to-end transaction with Celestia and the benefits?
Sure. So yeah, and I mean, I'll start with a normal blockchain. So a normal blockchain, a user would, sign a transaction using their wallet, send it in maybe via RPC or if they're running a node directly to sort of the network. The validators would gossip that transaction around. The next, proposer of the block would put that in a block and everyone would vote on it. It would be, confirmed. And then eventually the user would get a receipt basically saying, be able to check that their transaction was, included this block at this height, etc. In Celestia, it's slightly different. And that is that, if you're building an application on Celestia, you're building it as a rollup, right? And it's kind of like its own chain, is its own network that has its own sequencer, or it can be a set of sequencers. But the user would sign a transaction normally, but instead of sending it to an L1, they would send it to a sequencer, and the sequencer can immediately send them a receipt saying, your transaction is confirmed, like I guarantee this. And then the sequencer would batch a bunch of transactions together from a bunch of users and then create a transaction that publishes all that data on Celestia. And then that's where like the true finality comes from, is once the transactions have been posted to Celestia, they come back and they can point to the user that like, hey, now that transaction that I gave you confirmation of, it's like fully final, as kind of shown by like the Celestia layer 1, which is like the shared source of truth, as like the final ledger. And so the advantages here, and this is like kind of gets into, I mean, we'll talk about this a lot more, I think, as the latency that you can get. Like a core theme I think that people should have in their mind when they're thinking about this new paradigm of building applications is you can have the same kind of user experience as Web 2, but with the decentralization and the guarantees that you want, the security that you want from Web 3 in this design paradigm, because you have essentially like a server, the sequencer, that you as a user can interact with directly. You don't end up having this whole network that's very convoluted and very slow that you have to wait around for your transaction to be finalized, and all the overhead that comes with that. Like having this single touch point of a single sequencer gives you the instant confirmations, allows a single sequencer to just operate much more efficiently. But then you have the decentralized backend at the core, and like that's kind of I think one of the really, really big selling points, and one of the reasons why I think a lot of developers are starting to move and build in this more roll-up centric paradigm.
Nick, you guys obviously, I think Celestia really defined the DA model, but the space has evolved a bit. Maybe just put Celestia in the context for the landscape of the options that are out there with ETH blob space, EigenDA, near DA, decentralized sequencers. Like how should people distinguish between some of those, and how do you think that's like evolved relative to the thesis of what you originally thought Celestia would do?
On the DA side, there's actually not that much competition, and I think it's because there's just, I don't know. I think there's been sort of a lack of faith in this model. I think it's really kind of just Ethereum and Celestia. There are some other chains. I think you may mention Near. I think they may have one live chain. I think there's EigenDA has maybe 4 chains live, but then you have Ethereum with 50 chains and Celestia with 30. So it's kind of like it's a pretty huge like sort of drop off. And I think that's because Celestia has sort of been the first. We created the category even before Ethereum decided to pursue a more modular roadmap. It is like our expertise. We have the most integrations and sort of the most like distribution as far as like all of our partners. And so I think that kind of also leads into a little bit more about like the way that the landscape is played out. I think there was a proliferation of a bunch of different modular components in the early days when people were excited about this new paradigm. And now we've kind of gone through a bit of consolidation where there are these layer ones that do DA and consensus. They provide the raw block space. That's like Ethereum and Celestia. Then on top of that, you have roll-up frameworks, which are basically these software packages that help you as a developer, define the sort of like execution logic and other aspects of this virtual chain that you want to deploy. And those are the two primary sort of like components. Then you have roll-up as a service providers, which are sort of like system integrators, where they package all these different components together into a final product, a more polished product for someone who doesn't want to necessarily do all the engineering work to deploy their own chain. They can kind of hand it off to an expert who will spin up an Explorer for them, an RPC endpoint, make sure that there's bridging support. and oracles and all these other things that you need when you want to deploy a net new blockchain. And I think, I think that's sort of the high level. I would also say, at least comparing Celestia and Ethereum as when it comes to like actually being a suitable DA layer, Celestia is soon going to have 20 megabytes per second of DA throughput. That's roughly like equivalent to 200K TPS. And Ethereum, I think, is currently at about 0.1 megabyte per second. So we will have roughly 200x the throughput of Ethereum, and we have single slot finality, which means every Celestia block, which is every 6 seconds, you have full finality. In Ethereum, it takes 12 minutes. So I think these are kind of two of the big things that are sort of like defining the trade-offs of, a roll-up when they're decided between deploying on Ethereum versus Celestia. Like if they have lots of need for throughput, they're going to want to deploy on Celestia because there's actually abundant throughput for whatever they would want, whereas Ethereum's very close to saturated and just a very limited amount. In fact, 0.1 megabytes is, maybe 1,000 or 2,000 TPS max, which is just not enough for where we see the industry going. We wish there was more competition, honestly. I think that the DA market is potentially underserved.
That's interesting. So breaking down contrasting Celestia and Ethereum, it sounds like it's really a throughput game, right? Are there any other aspects of the DA or the services offered by both chains on the DA front that differ?
Can I follow up with that? Could you give some examples of applications that would be better fit for each?
Interestingly, is a throughput thing sounds on the surface like, okay, well, it's just about throughput, but actually it's also about things like latency, and I'll talk about a specific use case vertical that we're seeing a lot of traction on recently, which are DEXs, specifically these central limit order book DEXs. So for just a brief history for people listening, there's always been decentralized exchanges have been a huge category that's had product market fit in crypto since 2017 when Uniswap kind of came around, and yet the trading experience and the liquidity and the sort of the efficiency of these DEXs has been very, very limited, and now we actually have the capability to build on-chain these actually fully fledged central limit order book exchanges that are just as performant and capital efficient as any the highest tech exchanges that you'd find in TradFi, like the NASDAQ. And one of the things that's enabling that is actually this roll-up centric paradigm, because when you're able to run your exchange with a single sequencer, traders, market makers, HFT funds, like sophisticated people can co-locate with that sequencer and get 5 millisecond latency on their trades. And so you can have this sort of like real-time on-chain market. And now, why does that connect back to Celestia and the throughput conversation, right? Well, these DEXs have a need for very low latency and also very high throughput. And those things are connected because if every 5 milliseconds, if that's like your tick rate of like how fast your market's updating, there's going to be every 5 milliseconds, there's going to be tons of orders that need to be matched or canceled or placed. And each one of those orders is, let's say, 100 bytes of data. You can see how, there's 200, you have to do that 200 times for every second. There's multiple markets, like the amount of overall TPS and throughput that comes with that gets extreme, gets very big, very, very quickly. And so, and again, the latency part also means that the throughput goes up. Like the faster you're running your market, the more overall TPS that you're going to end up doing. So those things actually go hand in hand. It's not just like I need more throughput because I have more users. It's also like as you start to want to run your market faster, you need more throughput. So that's an absolute use case that you think, even if a lot of the teams that we talk to, like there's no way, even if they could take up all of Ethereum's current DA block space, the 0.1 megabytes per second, that's nowhere near enough capacity for them. They need in the megabytes per second of throughput for a single exchange. And we're seeing just a huge explosion of different teams building different approaches to the central limit order book dexes.
So I think it's implied by the higher throughput, but I was wondering if you could maybe take us through the different cost profile of the different DA solutions. What the cost is per megabyte of data posted.
Yeah, great question. So in Ethereum and Celestia, so for Celestia, we're pricing our data at essentially free, and just adding a fee that is for spam prevention, essentially. And we're doing that because we want to prioritize growth, and we think that like long-term amassing market share and also just like amassing the apps and users is really what matters in the near term. And in the future, we can worry about okay, how do we price this effectively, and what the economic model should be in more detail. Ethereum is also, I would say, similar. They have a economic model where the fees are pretty low until the block space gets saturated. And I think even with Ethereum's fees being as low as they are, which is extremely cheap, almost like free, like people are constantly saying that Ethereum's selling their block space too cheap. Celestia is roughly, I think, about 50x cheaper than that. So right now, I would say that the cost is not really a differentiator in the DA market right now. Now, that could really change if Ethereum gets congested, which is very close to being. Then the fees could start to grow and really become a problem for some of the teams using that as their source of block space. We saw that actually originally when Celestia launched. This is before Ethereum shipped their blobs, their 4844. They had only call data, which was extremely limited, and many rollups were paying millions of dollars every year in hosting fees, if you will, of consuming the block space on Ethereum. And so we had a huge migration of L2s from Ethereum block space to Celestia in late 2023, early 2024. Post 4844, the price of Ethereum block space came back down to something reasonable, and so that's no longer there's no longer sort of that incentive or cost problem. But again, there's a lot of teams that we talk to that are targeting these new very high throughput use cases, Clubs being a very good example of them, and it's like a non-starter. Like they already know that if they were to try to launch an Ethereum blobs, the cost would go through the roof. So, and in fact, like they couldn't sustain what they need. So I would say that's a kind of a more so than the cost. Again, is like the absolute throughput, and they're sort of like what you would call like range anxiety, in the same way that let's say you bought an electric car and you were concerned about, well, I only have 150 miles of range. That's not enough for me to go, I don't know, do my favorite hike that's like, an hour drive away or what have you. You start to sort of like, you always want to have extra. It's a similar thing, I would say, with block space. These builders want to build on a chain where they feel that there's excess capacity so that they don't have to worry about hitting those limits and suffering the consequences of like an infrastructure that's just not big enough for them.
Yeah, it's interesting. We spoke to Vitalik on a recent episode, and one thing he said was he'd be in favor of raising DA costs, blob space costs, on the Ethereum network. So we'll see how that happens. Now, you mentioned that you guys are focused on, growth first and foremost. Let's talk about some of the adoption and the KPIs. Nick, walk us through what are the most important ones in the from a top down. How should investors particularly think about it? Is it like customers, data, transactions? Like what's the KPIs that matter for forecast, for tracking the growth that you have your eye on?
Yeah, KPIs are really important. And the one that I think is most critical for Celestia, it's very different than for a lot of other. There's a lot of things that map from the way you think about a traditional L1 and how you think about Celestia, but there's also a lot of new stuff. And I think the core thing is, what is Celestia's product offering? And its product offering is its block space. It is a protocol that creates block space and sells it. And so the key KPI, I think, is how much block space demand is there. And that has actually been growing well in the past year. It's been roughly like 45% quarter over quarter growth. We're hoping that sustains and in fact grows even more. We're seeing roughly 10 gigabytes of data throughput on a weekly basis, and that equates to roughly 130 TPS as a baseline, which is pretty good, especially if you think about it in comparison to other L1 networks as far as like the total transaction activity. And then I think another really important KPI is revenue. And the revenue side, unfortunately, though, because as I was explaining on the pricing side, the block space is essentially free. By the way, I think Vitalik's absolutely right. I think Ethereum is selling their block space way too cheap. I mean, Base should be willing to pay significantly more to operate their chain on Ethereum. I would think same with a lot of these other leading L2s. And so I think Ethereum, I don't know what they should price it at. That's the hard question, is like, what's a fair price? And I think maybe we need some market mechanisms for that, or just set a higher base fee. But anyway, Celestia is in the same boat where I think our fees are so low that it's like not a meaningful metric right now. I think if we looked on chain, we're generating roughly like $50 in fees per day. And again, a lot of people point to that and are like, wow, that's crazy. It's evidence that Celestia will never make meaningful revenue. And I think that's wrong. Like if we, for example, if we were charging, a half of the end transaction costs, like per transaction that Solana charges, we would already be making like roughly 2 million in fees annualized just from that. And again, the Celestia economic model is one of scale. It's one of massive scale. Like when crypto is, when you have apps like these DEXs that are going to be doing tens of thousands, maybe in the future, hundreds of thousands of TPS, you can charge, even if you're charging a very small amount per unit of, per byte of block space, you're going to end up having that add up to pretty substantial, revenue long term. So like, just some back of the napkin math, in the future, far future, let's say we had a million TPS on Celestia, and we're just charging 1/10 of the current, end user transaction fee on Solana, then we would be making 3 billion in annual revenue. Now, obviously, like a million TPS, we're quite far from that as an ecosystem. But if you project out all these potential use cases of, financial things like exchanges, which, a single exchange could already bring us up to 100K TPS. That's 1/10 of the way to a million. Or if you have some of these more futuristic things like AI agents that are transacting using, microtransactions, using stable coins to pay to access content or to make API calls, you could see these like bot-driven transaction speeds to really explode as well. So Celestia is again kind of like an index bet on the future of growth of the demand to transact on chain and like overall adoption of Web3 applications.
Let's talk specifically about some of the customers today, right? I think like Eclipse is maybe one of the bigger posters. Is that right?
Yeah, Eclipse has historically been one of the bigger consumers.
And then who else, right? Like tell us some of the other bigger ones. And then you mentioned some categories, but give a little more depth in the pipeline of the growth of getting to the million TPS. The
current biggest users are chains like Eclipse, Hibachi, which is a CLOB DEX, Derive, which is like an options protocol, and also I believe they have a CLOB DEX. They're our biggest users now, but we think that they're very small fraction compared to like where we're going soon. Specifically, I know I keep coming back to this CLOB DEX thing, but we have a chain called Bullet. It used to be called Zeta Markets, one of the biggest perps exchanges on Solana L1. They are building a full stack, perps DEX as a rollup on top of Celestia with deep tie-ins to Solana L1 for liquidity and users. They're pushing performance at like 2 milliseconds, which is absolutely insane. Ethereum, which is an Athena ecosystem, DEX is launching soon. We have Rise, which is a high-performant EVM focused specifically on CLOBs and DEXs. Another one called Vex, a verifiable exchange. So there's like this whole, and there's a bunch of more that we're working with that are not yet announced. We're just, again, seeing this really massive kind of like pickup in demand from that category specifically. And I don't see that slowing down anytime soon. So I predict that in 3 months, when all of these chains I just launched and potentially others have launched, so like by Q1 of next year, I expect these chains to be far and away the largest consumers of Celestia DA. There's other use cases like stablecoins. We're working with a team called Pay, which is building sort of like an on-chain payments using stablecoin with privacy, and they're adding yield and kind of becoming this on-chain bank. What the overall transaction throughput of that will be is still to be determined. Visa, I believe, does like 10K TPS roughly or around there. And then we have Noble, which is also like a stablecoin sort of like application layer play. So very bullish on the stablecoin vertical. And would love to frankly see, I work with a team that's on the sort of more AI agents side of things. There's a team actually called Towns that is helping build these sort of like AI powered payment chatbots, which is interesting, that is built on Celestia. As far as other usage verticals, I think like the general DeFi sector seems to be really where the overall ecosystem of crypto is seeing product market fit. So that's where I feel like the majority of usage is going to come from. We have some prediction markets as well. Exo Market is launching on Celestia. They have a kind of a new spin on prediction markets that are going to be, it's going to be permissionless to create markets. It's going to have AI driven resolution of the markets. So less dependence on like oracles that can be gamed. So those are some of the users that I see coming down the pipeline in the future.
Yeah, I want to transition to talking about the token in a second, but just to real quick put a pin in the, you spit out the 1 million TPS coupled with a fee profile that is similar to 1/10 of the end user transaction fee on Solana, correct?
Yes.
That gets you the 3 billion. So I assume that there is some expansion of usage, but also it sounds like there's some price increase involved in that illustrative projection as well.
Yes, exactly. Yeah, I don't know off the top of my head what the difference is between today's price per transaction, per end user transaction versus 1/10 of Solana. I would imagine it's probably an order of magnitude or more. But again, like we're starting at basically zero. And my thought there is, okay, no one's complaining. No user is complaining about, 1/10 paying the current fees that they pay on Solana to send a transaction. And so if that's not a user friction, what's like the overall of the end user transaction fee someone's willing to pay? How much of that, what percentage of that could go to the DA layer? And I think 10% is a pretty sort of like realistic low like take rate. And so the thought there is that 1/10 of a Solana fee is a reasonable potential like base layer fee for Celestia to be charging. Again, it's really still to be seen, and maybe there's an argument of like the way the economic model works is more so, think of Celestia as, if you take the AWS example, it's more like hosting fee. It's like, okay, I'm the developer. End users don't even pay transaction fees on my blockchain, which I think is actually maybe a better way to build these apps. And instead, I just pay the hosting fees of consuming the block space on Celestia and running the rest of the infrastructure. And so in that world, these businesses, these rollups that are built on Celestia need to be making money, and then they need to be paying some portion of that back to the base layer infrastructure. And that's so the same way that like every startup has their cloud bill at the end of the month. And like, at least at Celestia, we have a pretty big cloud bill from all of the, testing and test nets that we run and stuff like that. And so I feel like this will start to just be a cost category that everyone kind of accounts for long-term when they're building an on-chain app. So we'll see.
Yeah, no, I think that makes sense. So let's chat about the token. Can you, break down the TIA token's core role in the network, how it powers data availability, and, does it benefit from, in the future, if there is significant fee revenue, does it capture any of that revenue?
Celestia's token, TIA, is very similar to any other L1 token. It's used in proof of stake. So if you have the token, you can stake it to a validator, earn yield. Those validators are the people who are finalizing blocks, voting, like running the consensus. And then on top of that, the token is used as the fee, like how you pay fees to the protocol when you want to use the protocol to publish transactions, to consume block space. When you want to consume block space, you pay a transaction back to the protocol. And in the future, it's likely that we'll implement fee burning, like a fee burn mechanism, so that as there's more and more revenue in the protocol, there's more and more demand for people to consume block space, Celestia's block space, then that revenue gets driven back into the protocol and into the value of the token. So that would sort of be the value capture mechanism long term. So, again, the way to think about TIA token is sort of like an index on whatever the demand is for people to transact on Celestia's block space. It's not, now I want to, the difference between Celestia and, let's say, Solana or Ethereum is Solana and Ethereum historically have made a majority of their revenue, majority of their fees from MEV and priority fees. And I've always taken the stance that I don't think that that's a sustainable economic model for L1s for a variety of reasons. One is like it's actually not really good user experience when people have to pay a bunch of money. And like if there's actually a better place to transact where they don't have to pay through the nose to send these transactions, and then they will go to that place. Second of all, the applications in this roll-up centric paradigm, applications have the ability to capture all that revenue for themselves. And they're just leaving, they're like leaking value to the L1 unnecessarily. And long-term, there's not a doubt in my mind that these applications will want to capture MEV revenues for themselves. So I think we're actually already seeing that too. If you look at the sort of revenues of Ethereum L1 and Solana L1, they're kind of, they've peaked in the past and they've kind of been in a downtrend. And I think that's, for better or worse, where things go. And now I think that forces a bit of a re-rating of L1s and how you value an L1 token. And I think that Celestia is kind of like, a lot of people have hated on Celestia for, saying like, oh, well, DA, if you just only do data availability and just sell raw block space as an L1, you're not able to generate the revenue from MEV. And it's true. And so, and people criticize Celestia for that. But I think that really we're just taking the long-term view and speed running the end game, which is that's going to happen anyway. And so we'd rather be ahead of the curve and be building for a world where there's a new economic model for L1s. And so that's what we're targeting. And that economic model is, again, lots of transactions at scale, lower margin, but as you aggregate enough throughput and transaction demand, those numbers actually add up to something very significant. So that's a long-term game of Celestia. And I could go into a little bit more about why I also think that there are network effects around block space and why there is not a commodity, not a race to the bottom, because that's also a key part of I think the economic long-term picture.
I would love to hear that. Yeah, I mean, it sounds like there are a few differences, obviously, but I think a lot of folks would push back on the whole DA thesis, and basically saying that it's a commodity, right?
Yeah, and I think I can see why people have that opinion. Now, so first, let's start out with just, again, comparing to the cloud model. Like, cloud compute is very much a commodity in the sense of, like, it doesn't matter if I store my thing on AWS or Google or Azure or, I don't know, Oracle, like, not really, right? So you'd think that, well, then the market should all end up like pricing to very, very low margin and everything being kind of the same, or like it would be trivial for someone to just spin up a new cloud infrastructure provider and compete, right, with the big boys. And like, that's just not at all what you actually see in the market. There's still actually very healthy margins. Like AWS is actually like a complete cash cow and makes 60%, I think, of Amazon's total like profits. So like 60% of the market cap of Amazon, almost you could say, is actually AWS. Like people think of Amazon as like a, this online retailer, when in reality they're actually like primarily a cloud computing giant. And similar things can be said about Microsoft and Google, like huge components of their overall underlying business. And so why is it that the cloud computing still has margins? Is because you have all these developer tools, you have sales teams, you have brand, you have like you have like support, you have this whole sort of like ecosystem around each one of these things that makes it sticky and makes it also like differentiated, and hard to just kind of like come in as a newcomer. And I think that the exact same things are going to play out on the DA market, where there's going to, like, the more integrations the DA system have, like we already see this, like Celestia is integrated with every other rollup stack. A lot of these other DA frameworks or providers had not been able to actually successfully integrate with many of the rollup frameworks. Like, it's a lot of work. It takes a lot of engineering hours. There's integrations with the service providers around that, whether it's block explorers, bridging providers, RPCs, Oracle, all these things. Like, you start to kind of develop a sort of soft network effect around developer tooling, the same way that the EVM, right, has a network effect around it as a developer ecosystem. You're seeing, I think, similar dynamics are going to play out in the sort of block space category. And then you also have brand too. Like, people want to choose a brand that they trust, one that has, a good track record. Like, Celestia has 2 years, no downtime, literally created the category of modular blockchains and data availability and rollups, and is a team that is going to be there for the long term. There's a lot of newcomers, like near pivoted to doing DA because out of FOMO, and like now I think to my knowledge, they've kind of like abandoned it. So there's a lot of people who like, come in and try to play the game, but they don't actually last because they're not serious. So all these components, I think, make DA not a pure commodity. And then, so that's just comparing cloud and sort of like data availability block space, right? Now there's actually something that is actually completely sets block space apart from the cloud business model. And that is, you actually have a hard network effect at the protocol level, which is that, and this is exactly the same thesis essentially as like all the people who are bullish on L1s like Solana. What is the reason they're bullish? Because of this word, composability, right? And I do think that the killer use case, or one of the killer features of blockchains in general, is composability. That I have this contract or this application that can perform some kind of, autonomous logic, has a certain amount of liquidity embedded in it, and now this other contract, this other application, I can compose with seamlessly, and you get this network effect of economics and business logic interlocking in like the DeFi Legos type thing. I think it goes beyond DeFi, like, all these, like, the more state and the more value that you have under one hood, and the more easily it can compose, the more it makes sense for the next marginal application developer or user to come into that system versus something else. And people think that building a rollup or building this new paradigm breaks that composability when it does not at all whatsoever. Because people think that the composability that matters is what is called atomic composability, meaning that this state and these users and this value lives within one shared execution layer where you can atomically compose, meaning that within one transaction loop, in one block time, you can make all those things happen at once. But you do lose that if you have everything in a separate rollup, a separate chain. It becomes asynchronous. Your composability does become asynchronous. Now, the beauty is that doesn't actually break the value prop of composability whatsoever. It might make it take a few block times, but the overall use case and benefits remain exactly the same. And there's so much like bridging progress that has happened to make that the case. If you use rollups today, you can already start to basically transact between them in a very seamless way. And then what does matter about the composability is trust minimized composability, meaning when I have a smart contract in Ethereum with all this DeFi TVL and on Aave, and I want to compose with, I don't know, some other DeFi protocol like Uniswap, let's say, these two protocols, these two DeFi like pools of liquidity and state don't have to worry about this one lying to them or doing something that's inauthentic and basically stealing funds and sort of like making the whole system rotten. And in order to achieve that, you can the whole point of rollups is they preserve that type of composability that is actually trust minimized, meaning like it's fully secure. And in order to do that, you need to live on a shared consensus and data availability layer one, like Ethereum or like Celestia. So like long term, what I'm saying is the same exact network effects around composability play out, but just at a layer deeper on the L1 as a block space provider, and instead of as smart contracts with these rollups, and making the state interoperate and building this ecosystem, this sort of like economy, this on-chain economy long term. And that's why another metric that we track and we do care about long term is total value locked or total value secured, and just like other metrics that track the overall economic activity on Celestia, because that is how we start to build a moat long term that then means we can have a higher margin on our block space long term. And that's where higher margins at scale, DA layers like Celestia can be extremely generate extreme amount of revenue.
Now, Nick, you've made the case for for not being a commodity, and you've also said that you kind of think the steady state is maybe 10% of the fees. But like from Celestia's standpoint, like how far out are we from you guys, getting that pricing power, raising the fees, and maybe it kind of dovetails into another section of questions, which is like governance, like, and how would that kind of go about with the decisions made on the network?
Very good question. I think for these bigger network effects to manifest, two things need to happen. One is, I think the interoperability stack within Celestia and just more broadly needs to get better. Right now, interoperability is primarily just moving tokens, from point A to point B. And that's not interesting. That's not that interesting. And you don't need that much security for that. Like security is not as like critical. It is sort of like, the bridge is taking custody of your funds. So it is important that it's secure. But when you want to do, what we need is interoperability that's more similar to the kind of interoperability that happens between smart contracts. Like, hey, something just happened on Uniswap that is going to be able to trigger, some other contract's going to be able to read that state, act accordingly, do some kind of liquidation, and then, interact with a lending pool. And like these kind of things, like if Uniswap lied to this, place where the liquidation happened, then all of a sudden, like some user lost their funds for no reason. So these are very high stake types of interoperability things. So when we start to do more of those kind of cross-chain composing state cross-chain like that, the need for security becomes much higher, and the network effect around one shared consensus and DA layer, I think, also increases. So we need that to happen. We also need just more value to move on chain. I think we're still in the very early beginnings of the adoption of crypto and blockchain more broadly, and I don't think that we've even seen like a thousandth or a 10,000th of the overall value starting to move on chain and be transacted natively on blockchain. So like we're still very early on in even developing the network effects. It's way too early to call anyone a leader. I know Ethereum has a massive amount of stablecoin TVL, but like compared to where we're going, which is like trillions of dollars of assets on chain, I think we're just still, it's way too early. And then I guess the other question was like, when will the economic model be improved, or how do we think about that? I think it's a priority, but it's not like the number one priority. Like again, growth is very much what we're focused on because we want to be the leader in the category. We want to amass as much market share as possible. We want to be building that moat as much as we can early on. It's like kind of the startup playbook is like grow at all costs, and then you can, like Facebook, figure out revenue later. But once you're established and you've kind of won to some degree. So I think that that's to be seen. I think a very simple thing to do would just be to increase the base fee, but figuring out what the fair market value is of the block space is tricky, and you don't want to just overshoot it and then like have a bunch of users complain and worst case migrate somewhere else. And it's also, I guess, dependent on the broader market of like Ethereum fees. If they start to go up, or they change their pricing, it could also open the door for us to follow suit. So it's very hard to say. In terms of governance, we have the CIP process. It's a open public process. Anyone can be involved in. Anyone can make a proposal. We don't have any on-chain governance, so that's on purpose. We just don't think that on-chain governance leads to good outcomes or is very efficient or effective. So we do everything through the CIP process.
Are there currently lab or foundation entities, and what role do they play in development and governance?
Yeah, so we have Celestia Labs, and we have the Celestia Foundation. Most of the organization that does day-to-day operations is in the labs entity. Foundation is where obviously the treasury sits, where grants to various ecosystem operators are made, and that's sort of like the way things are currently divided.
Nick, can we talk about some of the institutional ownership and kind of the history of that? Maybe just the easy question first is, who are some of the backers that are kind of still involved in, helping? And are there any on the liquid side that, are notable?
We have a lot of our original backers who are still very involved, very invested. Folks like Bain Capital Crypto. They've been amazing backers for us since our Series B round. Placeholder continues to be a big supporter of us. Maven 11, which was part of our seed round, was also has continued to be a really strong supporter of us. There's a much longer list, but I would say like as far as top three, those are the ones that are have been with us since the very early days and are still here, very bullish and aligned. As far as on the liquid side, we've had a lot of conversations with different allocators. I know that some of them have positions, but I don't have the most up-to-date information, and I know that they...
It's tough to know with the liquid market, yeah.
Yeah, exactly. It's a little harder to know, but...
That's filed here for TIA.
Yeah.
What are some of the terms of the prior rounds? Like, I'm just curious.
Yeah, so there was a seed round at a $10 million valuation. There was a Series A round at $70 million, and then Series B at $1. And then since then, there have been, we raised another, I guess you'd call it a treasury round, or maybe a Series C at $3.
And are most of those venture rounds, those tokens are for the most part unlocked at this point?
Yeah, actually, that's a very good point. So I'm glad you brought that up. Celestia's unlock schedule is actually much faster, more aggressive than what you're typically seeing these days. And it is essentially that at the so Celestia's been live for 2 years. The first year, no unlocks except for the initial airdrop and the tokens that were from staking rewards. And then from year 1 to year 2, first there was a big chunky unlock at the year 1 mark. And then there's been a continuous unlock from year 1 to year 2. And actually today, the last unlock for investors is completely over. So all the investors are fully unlocked. The overall float of the token, I believe, is roughly like 70 to 75%. So the majority of the tokens now are unlocked on the market. And so a lot of the supply overhang is behind us. And just since we're on that topic, Celestia started out with 8% inflation, stepped down to 7% in after year 1, and now we've basically realized that there's no reason to have such a high inflation rate. So we have decreased that now to 2.5%, which is going to land in the next upgrade. And then beyond that, so that's like a 75% reduction, I guess, or like 70% reduction from its original 8%. And then beyond that, we have a proposal that is still in the works for shifting to something called proof of governance, which would actually cut the inflation rate down to something like 0.25%. So 0.25%, like a quarter to 250 basis points, I guess. And that is something that we think makes a ton of sense because it will actually enable TIA to be used more actively in DeFi. We feel like staking is actually not a really productive use of the asset. And instead letting the token be liquid, usable in our ecosystem, able to generate DeFi yields, and just reducing the overall issuance and inflation of the token is a really powerful concept. And if the issuance is that low, the amount of sort of transaction throughput that we need to offset the issuance and become a net deflationary protocol becomes that much lower. So in fact, if we were to shift to proof of governance, and even at today's very, very low DA fee prices, at just 4.5 megabytes per second of DA demand, we would already be at the break even, starting to go negative inflation. And 4.5 megabytes, I think, is very realistic. Like even one or two of these DEX exchanges could potentially take up that amount of throughput if they're successful.
Curious, we talked about the we'll call it intentional lack of revenue at this point. What was the conversation like with validators in discussing and thinking through this reduction in inflation? I imagine they can't be that happy, because they're losing a lot of the inflation incentives, right?
There's a parameter in the protocol, which is the minimum validator commission. And so as much as you're decreasing the amount of overall issuance, you increase the validator commission, then they end up with the same money at the end of the day. And so, if right now we're stepping down from 5% to 2.5%, but we're doubling the validator commission. So yes, the total issuance is half, but the percentage of that issuance that goes to validators is doubled. So they end up with the same amount of money. But you're right. This is a very it is important that we keep in mind validators, making sure that they are profitable, and all of that, because they're a service provider for the network.
Nick, let's talk about what are some of the key risks. Not everything's that investors need to kind of watch out for, and then what are some of the catalysts coming up as well?
So Celestia is in a very strong position within the market of this category of, an L1 that is specifically for rollups, focused on block space, data availability. We're in a really, really good place. The engineering team has shipped absolutely phenomenal progress. So since we launched, I think we've scaled roughly 128x our original throughput. We've decreased our latency from 12 seconds to 6 seconds, so it's 50%. We just shipped a ton of really powerful stuff. We added more interoperability natively to our protocol, and all that. So I think like on the protocol and the product itself, I think is very, very strong. Now, the risk is getting people to use it and to adopt it, and in general, more broadly, the overall growth in the market for crypto generally. And I think on the getting people to adopt it side, we're getting very aggressive on the BD and growth side. Scaling the team, just going really, really hard on pounding the pavement and making sure we're in every conversation that's relevant. I think that we're also starting to, and I can't share too much on this front, but thinking about how can we incubate actual apps on Celestia to generate more revenue, drive more transaction volume, and just also demonstrate and prove out the stack to like dog food to some degree. We think that like in a previous era of crypto, it used to be the case where you had to be credibly neutral. You don't want to compete with your users and things like that. And we still take that stance, but we think that now it's kind of vital to actually be more proactive in not just going out and finding teams to bring them into your ecosystem, but even seeding your ecosystem more actively. So that's another thing, a way in which we're kind of taking adoption into our own hands. As far as catalysts, again, this supply overhang literally just happened, changed the change in like inflation rewards, like the whole supply dynamics of the token overall are going to change. These clubs that are launching in the next few months, I think are going to be an absolute step change in the actual usage and adoption of the underlying protocol. And hopefully that trend will continue as we see more and more high performance financial related use cases launching in the near future. Like I think we're still at the very early innings of like actually seeing how crypto gets adopted. And so, I'm very hopeful that like, I think where we are as a crypto industry right now is still so early, and we're seeing still such a small fraction of where we're going as far as the amount of value being transacted on chain, the amount of like just transaction volume generally. And so, Celestia's idea is to just be, the chain that actually has enough throughput and that has the right architecture to actually take crypto from where it's been to this sort of new era of much more broad mainstream adoption, and just like higher standards across the board. And so like, if we're right, like that is where the industry is going to go, then I feel like we have a very good chance of like capturing a significant share of that market. But I don't know, we could be wrong. Maybe there's no, maybe that just doesn't happen in the near term, and crypto still needs much more time to mature as an industry before we actually see, blockchains being used, on a daily basis around the world.
Nick, this has been a really great conversation. Appreciate you offering up the time. I'm sure investors that are listening certainly appreciate it as well. You kind of already, I think that kind of sounds like a pretty good summation, but I don't know if there's any other, key takeaways that you want to leave folks with before we depart today.
I've been in this industry for 7 years, and I remember when I was getting into it, I felt like I was so late. I thought, wow, I wish I knew about crypto like back when, Bitcoin was first getting started. Like I just felt like everything had happened without me. And now every year that goes by, I kind of feel that we're earlier and earlier than I ever thought. And, Celestia, from that perspective, Mustafa, one of the co-founders, he's been in the space literally since 2010. And so we've been around crypto. We are extremely crypto native, and we take a very long-term view. And we're here to stay, and we want to win in the long run. And that requires having a vision and seeing it through and having conviction. And I think this thesis of a cloud computing model for building decentralized applications makes tremendous amount of sense. And every month, every year that goes by, the thesis, from my perspective, only gets stronger and stronger. And so, I think if you're bullish on crypto adoption and you think that this sort of application paradigm of virtual blockchains that are super customized, super scalable, if you think that's also the direction that Web3 adoption is going to go, then I think Celestia is kind of the best expression of that thesis. We're really excited for the future, both near term and long term. And it's a pleasure talking to you guys. I really appreciate you guys giving me the platform, and would love to come back sometime, maybe in the future after we have more data points and have been able to ship more of these things.
Thanks, Nick.
That's a wrap for this episode of Level Up, where liquid token protocols meet the sharpest minds in institutional investing.
If you found value in today's conversation, don't forget to subscribe and share it with your network.
For more deep dives into blockchain's most compelling projects, reach out to us or follow the Medici network for more insights. Until next time, keep leveling up.